All right, so we have some looming tax increases. We're going to have increased rates. We'll talk about that, the Bush tax cuts that are expiring in about a month and a half. Expiring tax breaks, some of those have already expired and are expired for this year. Some of those are set to expire again in a month and a half. We have a new Medicare tax, which applies to investment income and earnings at different rates. This is a significant increase, and it's something we're going to need to pay attention to and do some planning for. And the alternative minimum tax. We keep hearing about these patches. They keep patching the AMT. They keep giving us a 1-year or a 2-year fix on the alternative minimum tax. This is a tax that was created years ago to make sure that the very, very wealthy paid taxes too. Unfortunately, what's happened is it's never been indexed properly for inflation, and now it's impacting families with much, much lower incomes. It was never intended to do this. The problem is that we're stuck with it because it's a huge revenue generator, and they either need to, they can't find the spending cuts in order to eliminate it. Once again, it has not been indexed. If it hits again, if it's not patched again this year, it will mean huge tax increases for taxpayers. As well as we have plenty of expiring business credits and whatnot. So the next slide shows increasing rates. It's a little bit confusing because there's a lot of different breakpoints on where the rates increase. But the takeaway from this is that for 2012, we have these lower Bush tax cut rates, as they've been called. We have a 10% rate is the lowest rate. We go to a maximum rate of 35%. That expires in a month and a half, and we go back to the pre-Bush tax cut rates, where the lowest rate is at 15%, and the highest rate goes to 39.6%. Again, slightly different breakpoints along the way, but certainly an increase in the overall tax rate. President Obama's proposal here, this is kind of an estimate on where it would end up if he gets what he's looking for, is extending those rates at the lower levels, but making the increases at the higher levels. Again, taking what we've done with the tax cuts, they all moved down, and now making it a little bit more progressive. So specifically, individual tax breaks that are expiring in December, there's a temporary payroll tax cut that expires. On the employee side of the Social Security tax, there was a reduction from 6.2 to 4.2%. That's due to expire in January. Long-term capital gains rates, the maximum rate for the last 12 years has been at 15%. That moves back to 20%. And all dividends are going to be taxed at the ordinary tax rate. So what that means for dividend income, if you're in the highest brackets, 2012 it's at 15%, 2013 it's 39.6%, plus you'll owe a Medicare tax of 3.8% on top of that. So we're into the low 40s with the tax rate. We'll have a reduction in itemized deduction. The reduction in itemized deductions reappears. And we remember years ago that if your income was at a certain level, your itemized deductions would begin to phase out. The benefit of those deductions would phase out. That was eliminated as part of the so-called Bush tax cuts, and that's coming back again. As well as phase out of personal exemptions, that comes back again. Refundable credits for AMT credits, which impacts people with incentive stock options, significantly goes away. The child tax credit that impacts all families or most families goes from $1,000 to $500. And some of the additional tuition credits that we've had begin to go away. So all of these are changes that aren't necessarily changes in the rates, but what we're seeing is we're creating more taxable income. It's not increasing the rates, but it's going to increase the tax. The marriage penalty reduction phases out. The earned income tax credit has some changes as well. And deductible medical expenses have been limited to 7.5%. The limit on that is moving to 10%. Now, the new Medicare tax begins on January 1. This is here to stay. It's not going away. This will go into place. For families earning over $250,000 a year, there's going to be an additional 0.9% assessed on their earned income. There will also be a 3.8% Medicare tax assessed on net investment income, again impacting families with over $250,000 a year in income. It applies to interest, dividends, annuities, royalties, rents, and other gross income attributable to passive activities, including capital gains. For business owners, this means if you're being taxed as a sole proprietor or you have income passed through from an LLC that's subject to self-employment tax, it's increasing the tax on that income. There are ways to structure business entities to avoid that, either by using S corporations or by structuring LLCs properly to avoid that tax, while still keeping them as active and not passive activities. So there are ways to structure to get around this at some of the planning that we're doing right now for our clients. Doesn't apply to non-taxable income, distributions from annuities, or retirement accounts. So retirement accounts should be free and clear, at least under the current law with this. The alternative minimum tax, we don't have a patch for 2012. The exemption falls from $74,000 to $45,000 for joint filers. I know that doesn't mean a lot. We'll get into an example of exactly how it does apply. The ability to use non-refundable credits to offset AMT is no longer allowed. And if the patch is not enacted, we'll have many more taxpayers that are caught in the AMT trap. Expiring business deductions and credits. We've had an environment where businesses have been able to write off essentially all of their equipment acquisitions, in some cases leasehold improvements, in the current year. So we've had the ability to take huge deductions in the first year. That's going away to a large extent. In 2011, we could write off $500,000 under the Section 179 deduction. It goes to $139,000 in 2012, and in 2013 it drops to $25,000, down to the levels where it was before 2000. We've also had, in addition to that 179, a bonus depreciation. Through 2011, we could just write off 100% of what we bought. That moved to 50% for 2012, and that goes to zero after January 1. The research and development credit has expired. It expired at the beginning of this year. We expect that one to come back. We don't know when, so we're trying to plan for next year. We still don't know what the tax law is for this year. The tax planning environment has just become an absolute guessing game. Gone are the years where we do 5-year projections of taxes. You know, we're lucky if we can project out 2 months. And in many cases, we don't know what the existing law has been for the last 10 months. We're waiting for a retroactive change. Work opportunity tax credit expires. That gives businesses credits for hiring veterans and in some cases, convicted felons. Various energy credits available to businesses are no longer in effect. All right, so how does all this add up? So we've got lots of changes, lots of rate changes, lots of deductions that go away. Let's look at what the impact is. I've run a scenario that has a taxpayer and a spouse both work. One is self-employed, one is an employee, each making $50,000 a year. They have another $50,000 in long-term capital gain and $1,000 in interest and dividend income. So we see the total income across the 3 years at $351,000. It's unchanged. The adjustments is a deduction that's allowed for part of the self-employment tax. The itemized deductions, the amounts that are in there are the same. What we see happen in 2013 is because this taxpayer is over a threshold amount, the value of those benefits has been reduced by about $5,000. So they're not allowed to deduct all of their deductions, essentially. The exemptions as well, we receive exemptions for each individual in the household. It's a reduction in the income before we calculate the tax. We go back to a phase out with those. This taxpayer's income's too high, and that's been partially phased out. So before we even get into the tax, we look at the taxable income, and where in the first 2 years that was relatively the same, it jumps up by $14,000. So $14,000 of additional monies we have to pay tax on. The regular tax in the first 2 years is pretty close, because 2011 and 2012 we have the same tax rates. But we get out into 2013 and it jumps up to $80,000 from $67,000. So about a $13,000 increase in the regular tax. The scary thing that's in effect right now is on the next line. The alternative minimum tax for this taxpayer is about $6,000 in 2011. 2012, it moves to $15,000. So we have almost a $10,000 increase in tax just from the alternative minimum tax that is current law today. We're hoping for a patch. We're hoping that that gets changed. But again, that's just a hope. We're not sure whether that will happen or not. We see an increase in the self-employment tax. That's partially this new Medicare tax, the additional 0.9% on those earnings. And we also see the Medicare tax, that's the 3.8% that's being applied to the capital gain and dividend and interest. So relatively small number, but it's still $2,300 that's going to the government that did not previously. So overall tax increases from $89,000 in 2011 to about $98,000 in this year, 2012, and then jumps up again to $103,000 in the following year.